Hello, everybody. We're back. I know we're a day late, but I'm Tom Sosnoff. He's Dylan Ratigan. This is Truth or Skepticism. How are you, Dylan?
Good. I'm excited for our special Christmas Eve bomb cyclone Truth or Skepticism. I mean, this is part of my holiday ritual now as a moment with you, before it all happens.
I'm not accepting this. It's a bomb cyclone in Chicago and a bomb cyclone in New York. I think the term bomb cyclone is being grossly overused. It's not possible to have bomb cyclones everywhere, all over the place.
Have you seen the map? It's a big bomb. It's a big cyclone bomb.
No, I'm not accepting it, like I said.
Louisiana, it's in Minnesota, Wyoming, it's in Chicago, it's in New York.
No, like I said, I'm not accepting it, but we'll see what happens.
Ask the newsman. Ask the newsman. But I think it's metaphor. I mean, the quote that I was thinking about today, whether it's the bomb cyclone or the sell-off in the market this afternoon, which I know is not, I think you have to be aware of present times. There's a selling thing. And also, I think Tesla's been a unique demonstration of this. The Mike Tyson quote that everybody has a plan until they get punched in the face.
Yeah.
And I feel like that whether you're just an investor who thinks, oh, it was a difficult year, whatever. Like, I think people underestimate the degree to which things can lose value and how quickly that can happen. And I recognize, the stats are stats, and fourth standard deviation moves are fourth standard deviation moves, but it doesn't mean they don't cluster. It can be distributed asymmetrically. And I think that they are always worse than people expect. So whether it's individually Tesla stock or the sell-off in anything, and we just watched it with Peloton and all these other things. I think people underestimate when something's down by half, how much worse it can get. And I think that that's a risk management component that's destructive to wealth and to people's attention. And so but I also am curious how you reconcile the decay and entropy, the chaos of bad judgment and loss with positive drift. Because I think that this is a microcosm, like you've offered a philosophy to this discussion over the last couple of years. And I would say that the antithesis of positive drift is these catastrophic cuts in equity values, individually catastrophic, perhaps. I won't say systematically. And that in this moment, it's one thing to have catastrophic equity cuts with whoever, some random people. And it's another thing if the superstar best manager, boy wonder, world's richest man shows publicly that he has terrible judgment, which maybe then means that the entire super CEO, the whole fantasy or Sequoia, where was your diligence on FTX? The whole professional class, it has a little bit of egg at the end of this year, which I wonder if that's affecting overall confidence in the market, quite honestly. So, I mean, it's a few different thoughts, I suppose. But one is the catastrophic. You can lose it. I'll give you two cents. This will end with 2 cents, not 50 cents, not 30 cents, 2 cents if you're lucky, or nothing. And everybody's been there 1,000 times, but people don't expect it when it's Tesla or it's like a huge company, Bear Stearns. But it happens. And so I'm interested in your perspective on that. And then the larger, and I think it radiates out to the things I've discussed.
Sure. So first of all, this is a topic that unlike most people that don't, other than for personal issues, most people deal with catastrophic personal issues, which maybe somebody gets sick, dying of something horrible, act of God, whatever it is. Most people deal with that as their outlier events. I've been in the market now for, over 4 decades. I deal with it on almost on a, I feel like on a daily basis. But
some percentage of your screen is going to get every day. It's because you have so much risk.
A bunch of my life has been specifically about this, starting with, the crash in 1987, all the way through to whatever I lived through today. So I've learned to deal with, at least I'm still here. Let's put it that way. I'm a survivor as far as, outliers and crashes and things like that. And I've had positions on in every single event. Like there's been no event over the last 40 some odd years that I haven't been involved in on it intimately with a large percentage of my money. Whatever it is, I've always been in the game with a large percentage of, today it's probably a smaller percentage than it was throughout the rest of my career, because as you build wealth, becomes a smaller percentage.
I understand. So anyway, so the point is you've had to come to peace with constantly being exposed to total wealth destruction.
Yes. And what I've learned from this is that, first of all, it's a very rare occurrence, and you cannot use it as a guide, or you cannot use it as a limitation. Like most people
you can't put it on the field as a boundary of judgment. You have to
not be, because it's unquantifiable. And we talk about, what happens. We at Tasty, we affectionately call it conditional value at risk, CVAR, which is what happens in the 5% of the worst. What is the average of the 5% of the worst events? Right. That's so basically it's outside
of the floor of a brokerage's risk management, basically, is
and a regulator. So everything goes out 2 standard deviations, which is 2 standard deviations takes you to 95% of the occurrences. So if Dylan Ratigan wants to make a trade at Tasty, okay, we only require capital that will protect us 95% of the time as a firm. Okay, there's 5%, which is unknown, and we don't know how bad that occurrence may be, and what kind of risk it'll put the firm under, or anything else. So we try to do other things, obviously, to protect ourselves. But and of that 5% of the risk, less than, let's call it 5 or 10% of that risk is in the realm of what you are calling
2 cents, like ham hocking, full ham
hocking. That's like 4, 7, 10 situations.
Everybody's got a plan until they get punched in the face. A Mike Tyson, a young.
Yeah. I know. I was curious whether Mike Tyson actually even said that, because it's been used so many times. I kind of think that
it's perfect. I feel like Elon Musk, and I know we don't want to do an Elon Musk discussion per se, but I just feel like, to the confidence to post the Tesla collateral at Morgan Stanley and say, listen, I'm going to post the Tesla collateral, I'll get my buddies. You're going to turn me into cash and give me, and I will hire lawyers, and we'll turn this money in New York into title and custody of Twitter. To banking deal. And it's just so bad. I've never.
I understand that. But just getting back to the main question here, like how should we view outlier risk of stuff that we can't quantify when we are taking risk, when we're making investments and taking risk?
And what if that company in the 5% is not Joe's, Crab Shack, but it's a Tesla? In other words, even if it's only 5, it may only happen 5% of the time, but sometimes it happens to Joe's Crab Shack statistically. What do you care? And sometimes it happens to the world's richest man in public.
Sure. It happened to General Motors. It happened to US Steel. It happens to.
But I think it has a different impact psychologically, I guess, is my thought, that when someone that you expect.
But does it?
That's my question.
So for me, as a trader, is it any worse if it's a stock that I may never even, I don't even understand what the company does, or if it's Tesla,
Only because of the number of people exposed.
Yeah, but as an investor, you're not focused on the number of people exposed. Like there are certain, the one thing about what you're talking about, that kind of crazy outlier, is that it's unrecognizable, it's unpredictable, it's not something that you can plan for. The only defense is size. So let's just understand that up front, because I think one of the biggest one of the things that's probably most misleading in the world is the idea that you can defend something when essentially the best time to buy something is when something essentially cannot be defended. You know, like you want to buy something into somebody else's panic, but then to turn around and say, well, you know, I should have sold that instead of bought it when I bought it because it turned out to be even worse than I would have ever imagined. I mean, going back to an example that you mentioned earlier would have been Bear Stearns. I remember when Bear Stearns was trading, you know, for down from 120 in 2008 down to whatever, $55. And we were selling the 25 puts for like $2, thinking this is the biggest joke in the world. They got, you know, $6 a share in cash, or I'm sorry, they have the equivalent of like some number in cash. There's no way the stock could trade at 3 times cash or whatever it was. And then let alone stock goes to zero. You know, like there's no way it could go to zero.
$2. No, it's $2.
Right. But there's no way it go under $25 at the time. We're thinking it was trading 50.
That's my point.
No, I understand. So and everybody understands that's, you know, there's no way GameStop can go from $6 to $500. Like it's not possible. It cannot happen. It goes both ways. So how do you defend that? Like everybody messes this up and there's only one answer. Like the whole world comes down to one answer. And the answer is it's just the amount of capital that you or I commit to a single thought, thinking like the idea that this is
the only risk is I understand what you're saying, which is that your only risk is your percentage of your resources at
That's
risk.
right. That's it. That's the only way you can defend that stuff. Because everything
what
else.
I'm getting at is a different thing, which is that you're saying it's no different if it happens in public to the world's richest man with the world's most important car company.
Of course not.
But I think it's different if it happens to a man who was the CEO and founder of arguably one of the world's most important companies, Tesla, and who is admired theoretically for some form of leadership and judgment, who just publicly walked his Tesla stock into a bank, cashed it in for money to buy a company, and made a fool of himself.
But that happens everywhere. It happens to
But you don't expect it everywhere.
It happens to politicians that are on top of the world that sleep with somebody they shouldn't have slept with. It happens to athletes. Like, look at Tiger Woods.
It hurts confidence in like value. I think part of the reason the stock that the market sells off today across the board is there is no smartest person in the room.
No, you're exactly right. There is none.
There's no room somewhere where there's someone who knows something more. Even if they know more information, they're prone to bad decisions.
Yes, there are people that are better risk takers than other people,
and better informed on subjects, experts on subjects.
There are better subject matter experts. There are people that are better at taking risk. There are people that are better gamblers for lots of different reasons. There are definitely people that are quicker decision makers. There's no question about any of that stuff. But in the end, it all comes down to extreme. And I'm not talking about reversion to the mean. Like like there was no reason that Elon Musk had to revert to some mean as a CEO or as a person. But there is an extreme. You get to the point where you think you are absolutely like he spent $44 billion buying a company because
he posted the global reputation of the world's richest man and Tesla's equity value as collateral to get Morgan Stanley to give him $40 billion to go hog wild at Twitter.
And whatever else he had
to
cost
him way more than Twitter at this point on paper. I mean, it's a catastrophe.
Of course. But that's more of a crazy ego. That's more of a personal
My
thing.
point is the reason equities are weaker across the board is because people are like, well, hang on. The people like to fall into the comfortable illusion that there's some class of people that are smarter that aren't going to make a fool of themselves. And that a lot of those people they hope are in charge of big fancy companies like that make electric cars or spaceships, or like that's where people would like to think, oh, well, this person must be competent.
People think that about politicians, and then they, like, for example, Putin's a perfect example. The fall from grace. Trump's a perfect example. The fall from grace. There's all these, people like that. You can look around you can go back to Saddam Hussein and whoever else you want to, Gaddafi. I mean, they all had at one point just basically unlimited power, and then next thing you know, they're hiding in a bunker. This is normal cyclicality. Like, people that get hung up on this stuff, it kind of drives me crazy, because to me, it's a master class in obvious. Like, everything is subject to gravity. And so it's only those who are most grounded. Like, I'm not a huge Warren Buffett fan, but from the sense of looking at somebody who's more grounded, that's that kind of person.
You just want a rich Midwestern old man who's just like, just wait it out, Charlie.
No, I'll have my dinner tonight at Dairy Queen. He's happy.
Come around. It'll all level out in the end.
Like, I don't think that Warren Buffett would have bought Twitter on a shot. That's all.
You're saying Elon's sort of ungroundedness and that judgment is almost the opposite. It's like one room is Warren in a Dairy Queen Sunday, like waiting out the railroad to see how it works.
I think Elon was doing shots of tequila one night and smoking a joint, and then decided, you know what? F it. Let's just do it.
And we can go to Morgan Stanley. We'll just tell them, take the Tesla stock, turn it into money, work it out.
I'm untouchable. Twitter. I'm untouchable. They can't say, nobody can say no to me. And
Morgan Stanley will say yes.
And he earned that right of nobody can say no. He earned it. But he messed up.
Well, I mean, again, I don't see how he doesn't have a big shareholder lawsuit coming on the Tesla side. I don't know what that deal looks like, and I don't know what those.
Well, that's where he messed up. I mean, but getting back to your point, which I think is way more important. Forget about Tesla, which is just talking about how things can get, a lot uglier than you ever think they can get.
So that brings up a different. So, but my point is, like if you use a stock and pick one that's down half, whatever it is,
everything, not everything, but a lot of stuff.
Crowd, but let's say just something goes down a lot, whatever, 30, 40, 50, 60%, anything, that by definition always attracts a crowd. Half the crowd thinks it's going to bounce back up. Sure. Half the crowd thinks it's going to go lower, but it attracts liquidity. And people are like, something's going to happen.
Sure.
Some point volatility expands, blah, blah. And a man like yourself will always say, well, that's when you sell volatility, because they have no idea. And they're all showing up basically overpaying any which way by definition, mathematically. And that's where opportunity lives. That's why I started Tasty.
Sure, of course.
I got it. But are there situations in your life as a trader where when something's down a lot, have you been in situations where something's been down a lot? I'm interested in a sort of a Christmas war story where something was down a lot that you thought, can you tell do you think you can tell the difference in something that's down a lot and is prone to come back, or something that is prone to collapse?
No, I have no idea. I mean, I can give you probably 20 examples of stocks I have right now that I own that are under $10, in some cases under $3 or $4, that I bought much higher because I thought when they got under $10, they were prone to come back. I can also tell you that I have stocks right now, like Amazon's one of my largest positions, that I'm probably out $10 on it now. It's trading for 82.5, and I probably bought it at 92.5. And I waited, it's down, after it split from 125 to 92, it lost, 35% of its value after this post split, and it was down pre-split. So I looked at that as, hey, you know what? That's an interesting opportunity. So I do buy stuff all the time that I think has gotten crazy, and I sell stuff that I think is crazy expensive.
And in the process, you form an opinion. You say, well, this one's going to go to hell. This one is.
Well, that's human nature, isn't it?
Every human being, right? That's a primitive human response.
Yeah, of course.
You must see the irony that you yourself have established a business quite lovely and prosperously, whose entire point is you don't know.
Yeah, exactly. So I'm not.
But then you, as the shareholder and founder and teacher, still yourself are prone to the human primitive compulsion to know.
Well, I
Can't
don't.
go any lower. This can't go any lower. You can't. You get that the thought you can't prevent happening, or this has to go back up, or this must go down. It's impossible.
When I buy stuff, I don't think it, like I just bought some Robinhood earlier today. I've already long some. I just bought some more because it traded under $8. And when it did, I don't sit there and go, this stock can't go to $6 because I know it can. But I rationalize everything different than everybody else. I rationalize everything based on what I call pot odds. And this is just a Tom thing. Pot odds to me are, listen, I'm buying this stock at $8. I know this stock can go to $6 or maybe $5. I don't know, but I know it can't go past 0. So, but realistically, it's probably got a downside of, let's say it's trading under 8. It can go to 7, 6, 5, whatever. But I don't think so because the puts in there are really cheap. But whatever the case is, I know it can go lower. But I also think it can go 2 or 3 times higher than the amount I think can go lower. So if my best guess the downside is $6, that's $2 lower than where it's currently trading. I also think it can go up to $14. Okay, that's $6 higher. So when I think about that, I'm like, I don't know anything. I don't know anything. But when I look at something like that, I'm sitting there going to myself, well, why wouldn't I, if I think it's a 50-50 shot, why wouldn't I take 3-to-1 odds? Like, that's how I justify it.
But ultimately then what you're describing is your trade entry filter.
Yeah, of course. Well, you asked, how do you justify it? How do you make that
And
trade?
you're saying that your entry filter becomes, after you get over whatever the hurdles of liquidity and whatever practicality is what you just described.
Yeah, I mean, listen, Amazon's trading at $82 right now. I think the stock can go to 70, which is $12 lower. But could it go $36 higher, which only takes it back to, 120-ish? And the answer is, of course. I'm barely, if the wind blows, it can go back to 120. So I love those kind of pot odds. Now, so far, those trades have been wrong. But that's what, to me, now you slap a strategy on top of that, which is like a high probability strategy, which doesn't mean anything other than you're selling some junky out of the money premium to effectively get long or to get short in a different situation. But since we're oversold now, or the perceptions we might be oversold, that I like the, selling some out of the money put premium gets you to a point where you're a little bit long, gives you a higher probability of profit, gives you a little bit of cushion to the downside. And then you have these crazy pot odds to the upside. I like that stuff.
Mm-hmm. No, it's fabulous.
But to me, that's what trading is.
But going lower.
But then you stay small. So the key is then you stay
that's
small.
the issue, right? Is you're like
The problem is, Dylan, most people, if they have $100 to do something with, they say, give me $100 worth of that.
or at least 50.
Or at least 50. Nobody says, give me 10.
10.
Give me 5, give me 10, give me 15. Nobody says that. Nobody. So for the person with $100,000, it's the same thing. Okay, Amazon's an $82 stock. Okay, that means for 100, I can do 1,000 shares, and it's $82,000. Okay, done. I understand, but that's your 100,000.
As opposed to 5,000. Your whole point is that that's the greatest road to destruction.
Yes, it's all size. Long-term capital management, Victor Niederhofer, the 87 crash, the 2000 and the 2000 meltdown of the dot-com stocks. The whole issue with the 2008, banking system was all size. Everything was size.
And alternatively, Elon Musk became the world's richest man by always staying all in.
He snowballed it. He is one of the
all in every time.
He's one of the only examples. We call that snowballing. And he's one of the only examples of snowballing to becoming the world's richest man like that. He's the only example I could ever think of where he literally mortgaged the house.
Double or nothing every time out.
He literally mortgaged the house to take his shot to go all in on everything. Incredible.
And just did it again, much to everybody's chagrin, but that's a different issue. the battle between the psychological desire to believe that you know and the mathematical ability for things to get much lower, I think is very challenging. It's been challenging for me at times, for sure, where you're right, but it's just wrong.
It's the reason that Tasty is so successful. Is because that isn't
People learn how to manage that problem.
no, because the intellectual question that's embedded in what you just said rings in between everybody's ears that's an active or accomplished investor in any way. That's the issue that they're always trying to solve. It's the issue that we're trying to not solve, but optimize for mechanically. Mm-hmm. From day one. And that's what resonates with everybody. Yet the industry has never figured it out. But I don't think they wanted to, because as long as that question goes unanswered, then there's a conflict and somebody needs to manage your money to solve that conflict.
Because justifies a third party.
That's right. That's why Morgan Stanley's in business. That's why Goldman Sachs exists, was because people believe that they can solve that problem. When they can't, they're more clueless than anybody. But people believe that because of the name.
And so I mean, that's an interesting discussion, honestly, because depending on the seriousness of the comment you just made, you do wonder whether of the core equity of banking, especially in that advisory domain, really resides in allowing people to feel like someone else knows. Even if you're Elon Musk, right? He still wants to call Morgan Stanley at the end of the day and say, listen, they'll figure out how to deal with the money. Like, just tell them they can use the stock as collateral.
It's professional wrestling in finance. Okay. Nobody in the world of professional wrestling will ever tell you that professional wrestling is not real. No matter what they think, they are trained from birth to defend the story, whatever. You will never, ever hear anybody say, hey, you know what? Yeah, we staged this or whatever it is. They will never tell their tricks. I mean, it is designed. You have to believe. And in the world of financial services, it's the same thing. Listen, this is the story. If you want to participate, you have to believe, and we make a difference. We are experts. That's why we spend all this money on research. That's why we have all this technology. That's why we rent Bloomberg machines, whatever it is.
Train all these smart people from these fancy.
That's why we hire everybody from Harvard and everybody from Princeton and
Cal Poly and MIT.
Exactly. We have quants on top of quants, and everybody believes the story. Everybody. Okay. And so that is the message that's been sent forever. That's it. It was always, when we used to trade on the trading floor, it'd be a bunch of misfits from Chicago public school systems, from dropouts from.
I used to say in New York, because I worked on the floor of the New York Stock Exchange as a reporter for years. So I was part of that culture in New York, not like you, but for years in New York, I lived in Tribeca and worked on the floor.
These were law school dropouts.
Everybody on the floor, perhaps myself, I'm sure myself included, it was like you could work on the floor of the New York Stock Exchange, or you might work on the docks.
Exactly. It's my point.
It's not like the New York Stock Exchange or like upstairs in some glass box skyscraper.
No. We hired, offensive
worker or exchange worker.
We hired offensive linemen from the NFL because they were huge in size. Whereas they were never getting a job at Goldman Sachs, as a financial analyst or as a money manager or investment banker. But we hired them. But they're all the same. Everybody's all the same. Doesn't matter. All the same. And so, that was always the joke that we would be like, people would never believe that the people that we hired knew anything about the markets, but yet they would listen to somebody because they went to MIT. it used to crack me up.
And that's basically sort of like the downstairs versus upstairs cultural history of Wall Street, really, right?
Yeah.
The bank upstairs and trading downstairs, and the illusion of the sort of of the brilliance of people who know, which I think is the most interesting thing for me, whether it's people think the bankers know or people think Elon Musk knows. And then I think a human desire to feel like they have someone who knows. I think that I think there's part of human nature is to want to believe that there's someone somewhere, whether it's someone that knows something.
Well, it
Which
is human
why
nature.
your message is difficult sometimes, because you're saying, no one else knows. Even if they think they know, they may make a better informed, more logical decision, and they may be right more often, but they're just as vulnerable to being wrong as somebody who doesn't know anything.
Yeah, but yeah, sure. I mean, to me, that's always been the beauty of this business, and so, one of the things I love about auction marketplaces and free marketplaces is that they can get very extreme in both directions, and extremism is kind of the basis for opportunity almost anywhere. When anything gets too extreme, it's usually, and
there's a lot of extremity in liquid U.S. equities related to companies and ideas.
Yeah, there's a lot of extreme in everything that freely trades. It doesn't even have to be, like a year ago was used cars, now it's not anymore.
That you don't think, because I think there's been a loss of confidence, not just because I think that the combination of the FTX situation and the Tesla Twitter situation has tarnished the reputation of the boy wonder as a problem solver in private sectors. Which
Doesn't.
It's been a core piece of the mythology of valuations, at least in tech, for the last 10 years.
It will never happen. They'll never, the boy wonder or girl wonder will never go away, because people love that. They
love it so much.
Yeah. They want somebody, but that person always changes. Like there has to be a rotation, and when you get there, it's impossible to stay there because you get so hung up with it. It's absolutely impossible to stay there. But it is a fascinating phenomenon. People really do love it.
I mean, it's mythological, right?
Yeah, it is. It is mythological.
Must be a boy or a girl wonder must be created and elevated, and then publicly dismantled in a horrifying way that's to everyone's delight.
I mean, you can't name anybody in the world of finance that hasn't gone. I mean, just comes right to just like, a perfect example would be Cathie Woods. I mean, another example of
fabulous, all of them. Yeah.
Wonder Girl to garbage almost overnight.
With the Roman crowd's delight.
Of course, but it's all like that. Everything, this whole industry has always been like that. I mean, you can go throughout the years. Remember Elaine Garzarelli and all these crazy.
I lived at the building I lived in New York for most of my time. The penthouse had been rented by the guy, Joe Jett or something, who had figured out, he was at one of the trading firms, and he basically figured out how to take interest only pieces of broken debt, principal only and interest only, like pieces, and would buy all the parts. Let's say it was 31 parts, like 30 years worth of bond payments and one interest payment, let's say. So 31 pieces, and he would buy the 31 pieces, turn it into one piece, a bond, whatever it was. And there was a spread between the cost of buying the 31 pieces and like trading 4 quarters for $1. But
yeah, sure.
But he was trading against himself. My point is it's all a scam. People love it, but that's why they like Theranos. But I think that's different. I don't think Elon is in that space. I think Elon is a gambler gone bad. Yeah. I don't think he's a criminal. I know he creates real things, or has, inspired the creation.
100%. I love my Tesla. It's the most beautifully designed car I've ever been involved with, ever. Nothing's even close. So no, of course he builds things, but even those people can get carried away. You get carried away.
So you
That's
got
all.
a guy at Morgan Stanley who's like, sure, I'll get you 50 billion cash in a week. Just give me your stock. I mean, that's a rare phone call to make.
Yeah, one of the things I always, loved about Jordan, when he was playing and he was at the top of his game was that he never tried to do anything else. Like he's like, listen, I'm not into politics. I'm not into this or that. Like I am what I am. Like I always love
Gonna
that.
run money on the side, some crazy scheme.
Yeah, listen, let me be. I just want to gamble and
Right.
and have my life, and I'm good. I just I want to crush your dreams and hopes on a basketball court.
But why? So why do you think the markets are as weak as they are, and why do you think a loss of confidence in management judgment is not a factor?
When you say the markets are as weak as they are, we've been trading in the same range now for a crazy long period of time, like almost months. I mean, we're up 65 handles yesterday, and the S&Ps were down 95 as we're talking right now. I mean, we've been trading in this range now for probably close to 5 months. So I don't know that we're that weak. I think that we've had 10. First of all, we've had 12, 13 years of pretty much a nonstop bull market. Like the idea that we have 1 year where the market pulls back and prices normalize is to me, is so obvious and so necessary, as it's almost like it's self-correcting, and it's commoditizing things that had lost their sense of real price and real value. That it totally makes sense to me. There's nothing that happened this year that didn't make sense. The craziness of what's happened the last couple of years between the crazy prices people were paying for things and the SPACs and IPOs and cryptocurrencies and all the
multiples on all this batch of superstar stocks.
Sure.
Companies.
Sure. People just people thought they were going to die. They didn't care what they paid for stuff. That's what the pandemic did. All of a sudden it's like, oh my God, if you breathe on me, I'm going to die. So I don't care what I pay for this. That was the attitude.
I'll play a game with money
I'll play the game. Sure. I don't need to work anymore. I don't need to go to the office. I don't need to do anything. All I got to do is buy some stuff and hope it goes higher. I mean, we've lost, we've become, what was exposed is there's a speculative side that people like to participate in, which is cool. I just think we have to, things are going to be commoditized. They're in the process of being normalized, which is a good thing. I think there's really decent pot odds out there in certain places right now. And I would expect that this is far more opportunistic now than it is dangerous. Like I love all the people out there. Everybody's out there. Oh my God, this is the end of the world. Part 73. No, this is opportunity part. This is the best opportunity we've had in probably a decade. Shut up and play, and stop crying about it. Just take your shot or sit on the sidelines. I don't care. Hey, you can get money on your cash now. So just be quiet.
I think Tesla's going to 25.
$25. I mean, there's a chance they can squeeze them. I don't think it happens. I mean, right now there's
170 to 130 in the last week after being down half, maybe 100. I don't know. I just have multiple still 10 times the other car companies. It's a disaster. It's a full disaster.
Yeah.
Cloud, Twitter, reputation, multiple.
Well, I think the worst thing
bad data today. I mean, they don't even have good data.
It's reputationally, it's hard to recover.
That's the biggest cost. The biggest loss is the world's richest man with the world's coolest company has lost his mind, which is bad for the world's coolest company.
What I don't like to see is when people become, when they go from like godlike status to becoming toxic. That's always a little ugly, and it's hard to get rid of the toxic nature of, it's a very hard thing to shed
It's a smelly fish, and
Yeah.
no one wants to be around it.
It takes a number of years. I mean, just look at look at Tiger Woods. He's a perfect example of somebody that it took a long time to get rid of
From God to a stinky fish.
and then it took him a long time to get back to where,
Be a guy. He could be a guy.
yeah. And it happens. And there's a lot of people in business. It's even harder because people, once they lose confidence in you, they're not willing to write the check anymore because they just, I mean, listen, everybody's always going to write.
And there's so many people you can write checks against that are younger and haven't demonstrated ham-hockery.
Yeah. But people are still going to write checks for Elon if, yeah. I mean, it's really hard to build $1 billion businesses, multiple of them. It's never been done before at the level that he's done it with, multiple $100 billion businesses. I mean, nobody's ever done that before. Nobody.
And again, to say that it's not going to work is, part of the fun for him is the heat, right? And now it's hot. He's got everybody hot. So you can see if he can pull off a magic trick.
Well, we're out of time here, Mr. Radigan. That was fun talk today.
Yeah, thanks for the time.
You saved the market, just so you know. While we've been talking, the S&Ps have rallied back, 25 handles, so something. And I see that they just released Sam Bankman-Fried for a guy that said he didn't have any money left. Said, remember he did his little thing. He says, I got less than $100,000 left if I even have it. Well, somehow he came up with a $250 million bond.
250 million?
Yeah.
Oh. That's ridiculous. So
somehow he had a little something left somewhere.
You found something in the couch, $250 million, just lying around.
Yeah, well, he didn't have any money left, but somebody did. Whoever he gave his money to, his parents or somebody.
Somebody's got a $250 million on the side.
Well, on a $250 million bond, you probably have to put up, I don't know, 10% or 20%. I don't know. I'm not a bail bonds. I haven't watched Dog the Bounty Hunter in a while, so I can't tell you what it.
A Zoom call with Andrew Ross Sorkin saying he's got $100,000.
Well, like I said, I haven't watched Dog the Bounty Hunter in a while, so I don't know exactly what you have to put up to get out on bail.
So is Sam going home? Is that the good news for Sam? Is he out of jail?
I can guarantee you he's got more ankle bracelets on him than anybody in history.
Like he was in a hurry to get out of the Bahamas all of a sudden.
It turns out the Bahamian prisons aren't exactly as cool as you think they are.
Says he for a depressed vegan. He wanted a special standing as a depressed vegan, I understand.
Good luck. All right, Mr. Radigan, I'll see you next week. Have a great holiday.
Happy, merry things.
Happy, merry thing.
All right.
Goodbye.